As like many investors at Baillie Gifford, my background is in the arts and humanities. I studied international relations and modern history at the University of St Andrews. My entire professional career has been at Baillie Gifford. I joined the investment management graduate trainee programme in 2012. I spent my first year on UK equities. I then moved to a global equity income product and then spent the next 3 years as an analyst on the high yield team and became co-manager of the high yield bond fund in January 2018. Our approach to the high yield bond market has been incubated within a distinctive long-term equity house over the past 18 years. This is, and of itself, unique and has resulted in a unique methodology. We have a forward-looking research approach that seeks to identify a diverse range of underappreciated, resilient businesses that are adapting to our changing world. We lend typically to growing companies that seek to fund that growth in a sustainable way, taking into consideration all stakeholders, the environment and society. In doing so, we believe that our approach can capture the opportunities of today and the future, delivering long-term income, not short-term yield. So we seek out resilient businesses, so businesses that can adapt and thrive in various market conditions through the cycle. And we define resilience as comprising 3 factors: a durable competitive position, good governance and a sustainable approach, which is synonymous with ESG, and an appropriate capital structure. So we analyse and score every company we look at for investment on each of those factors and apply an overall resilience score of anywhere between 0 and 6. So we would never invest in a company that scores less than 2 overall. We have never invested in a business that has scored less than 1 for competitive position. And this speaks to a natural quality bias that's in the portfolio and that has always been there. If we have identified a bond that we think is sufficiently resilient, as well as offering a compelling valuation opportunity, we typically lend to that business over a 3 to 5 year time horizon. So the fund has top quartile performance in 1, 3, 5, 10 year and since inception. We believe that's testament to the strengths of our approach, that we've been able to avoid all of the recent blow-ups in the market, despite actually having held some of the companies in the past that have gone on to underperform after we've sold. An example of such would be Senvion, a wind turbine manufacturer that has a global leading market position, but it operated in an industry that was in a state of flux as government subsidies fell away and in competition began to heat up. We recognised early signs of fundamental deterioration and sold out of that bond in the 80s, and that bond then went on to trade into the 20s a few months later. So I think that point demonstrates that we don't just invest in resilient businesses and rest on our laurels. We have to actively monitor the resilience that we initially identified to understand whether it remains and how that business is adapting to the changing world around it. So broadly speaking, our fund tends to outperform when the market materially sells off. It tends to underperform when there is a dash to trash, but overall it performs well, it holds up well, which explains our industry-leading outperformance over 18 years and the fact that we are 50 basis points ahead year to date. So our fund offers top quartile performance with an 18-year track record for some of the lowest, if not the most competitively priced fees in the industry at 37 basis points with no entry or exit fees. This charge covers all aspects of operating the fund, including investment management, admin, and independent oversight functions.